Money Radio for a really great future. We're talking real money.
Well, here's a test of your age. I'm feeling a little like the Maytag repairman. You know what that means? Then you're old. If you don't know what that means, then you're young. Hi, everybody. I am hanging out alone. A little raspy. Hold on. I had to do a throat clear, so I had to punch the button. I'm Don McDonald. Tom is not here. Tom is in, I believe, Germany. I think he's in Germany right now. He's doing a whirlwind, well, not a whirlwind, a gradual European tour. As he went from London to Berlin, and I think he's in Leipzig today. And I, on the other hand, am sitting behind a microphone in my Florida studio, spending time with you, because I am devoted to you. Yes, I am, and I'm here to help you manage your money better. Because, well, that's what I've been doing for about 40 years, helping people manage their money better. Now, for over 40 years, I've been in the financial industry, but for the early part of that, I wasn't helping people manage their money better. I was a young pup, wet behind the ears, didn't know an open-end fund from a closed-end fund when I started. I, of course, learned a lot along the way, and I learned that this stuff is not as complicated as they make it seem, particularly as much of the street makes it seem. And the street, by the street, I mean the people in the financial services industry who make lots of money helping you manage money. Sometimes I think they make too much money. I do. But, you know, it's a capitalist society. I'm okay with that. I'm a good capitalist. I like making money too. I just want it to be a little more reasonable. And so I'm always on the lookout for advice that is, well, less than helpful. Advice. Now, I love information. I love access to great information. And one of the premier sources for that great information is Morningstar. They provide wonderful data, wonderful data. Oh, by the way, I forgot to mention the phone number because I want you to call. That's 855-935-TALK, 855-935-8255. And so since Tom is gone, I'll need you to keep me company. 855-935-8255, and I'll be here for, better part of a couple hours. So give me a call. Anyway, love Morningstar for their information. I have used them for information for all of that 40 years, pretty much. 38. I use the tool as a way to analyze mutual funds and exchange-traded funds and even stocks once in a while because it's just really good information. Great data. Great data. However, when they cross, in my opinion, from data to opinions and recommendations, I think they fall wildly short of the mark. Wildly short of the mark. Because I think they're thinking, and I'm speaking for them. I have no idea if this is what they're thinking, but I think their thinking probably is, well, you know, we represent all of the mutual fund industry. We share information on all of the mutual fund industry. So we're going to be blind to fees and expenses. And I do believe they are blind to fees and expenses. I don't believe they factor them in to their ratings. And I haven't believed this for a long time. I don't like Morningstar's ratings. They give these medals to them, their medalist ranking, and you can get a gold, a silver, a bronze, or you can be neutral. And it's interesting the funds to which they give the gold rating. They claim it's the parent company, it's the processes they go through, the quality of the people, but the fact that they have people factored in to their rating is one of the things that I think makes their ratings so suspect, because they give ratings to how, quote, well managers manage their funds. Now, to me, it seems like there's a bias there toward activity. And the reason this came up is because I saw a recent article on their ratings for target date mutual funds and ETFs, and I was really shocked. And I want to share some of that information and why I think it's bad with you. 855-935-TALK is the phone number. Please give me a call.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more detail.
Your guides to a really great financial future. Tom and Don are talking real money.
Hey, welcome back to the program. I'm Don McDonald. Tom's on vacation. Thank you for tuning in on the radio. And thank you for listening to the podcast. Either or both. My phone number on Saturday is 855-935-8255. And the 8255 part, so it's easy to remember, spells talk, T-A-L-K. And what do we talk about? Well, the names in the topics in the name of the show, and that is money. Real money. Really important stuff about money. Hopefully, my goal is to try to only provide information that's in your best interests. Does that mean it's always right? No. As a matter of fact, I had a correction a little later on for something I said in the Friday show, so I'll tell you that in a minute. But give me a call, 855-935-8255. This past week, I read all this stuff so you don't have to. All the advice stuff and the personal finance and the investing stuff, I probably go through, 100 articles a week. Just to see what's out there, to look for little gems or problems, things that I think you need to be aware of. Most of the time, it's bad as opposed to good. Rarely do I see really great investing or financial advice in the financial news media. It's generally pretty bad. And I think there's a reason for that. And this goes back to the Morningstar dilemma. I think the biggest reason for that is who's paying the bill? Who's picking up the tab? How is Morningstar paid for what they do? They have subscriptions, and that pays for a part of it, but they also have sponsorships. I mean, when you go to Morningstar.com and you start to look something up, you'll usually see a advertisement at the very top of the page for a mutual fund company. And often those mutual fund companies are very pricey, loaded, high-fee funds. Matter of fact, there's one right now for Aberdeen funds, and they're closed-in funds, which we generally don't believe in. But they advertise there, so they're paying Morningstar money. So is it good for Morningstar to give them low scores if they can help it? Probably not. So let's go back to this target date mutual fund and ETF list. The headline of the article, so you know what it's about, the best target date funds. Morningstar's top-rated strategies for retirement. So I looked at the list. Now, right on top of the list is one that it's hard to have a beef with. That's the BlackRock Life Path Index, although they tend to be, they have some alternatives and things in them which don't make it a favorite of mine, but the fees are low. It's, a reasonable strategy. It's fine. Number one, no. I would never put it number one on my list, but it's okay. It's after that things get a little dicier. Because number two, and they consistently rate this company very highly, and they do spend a lot of money advertising with them, and that's the American Funds Group, the Capital Group. That's the name of the corporation that owns the American Funds. Their target date retirement is number 2. And I'll tell you how or why I believe they don't care about fees. Because that fund has a 5.75% front-end commission, 5.75% front-end commission, and annual fees of 2/3 of 1%, 0.66. Compare that with Vanguard's target date funds at no commission and 0.08%. However, Vanguard's target date funds are, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12th on the list. 12th. They only get a silver. They don't even get a gold. And yet they're dirt cheap. And by the way, that dirt cheapness is going to go to the bottom line. If you charge less, you return more to your shareholders. It's such a simple formula. And it's so infuriating to see them giving a high rating to a fund that charges you over 5% of your upfront money to get in, and then 2/3 of 1% every year just for the fund. You're not buying help for that. You're just getting a mutual fund. Above Vanguard, they have T. Rowe Price retirement funds. No loads, but expense ratios over 0.5%. Above Vanguard, they have PIMCO funds. PIMCO funds have a commission of 5.5% and an annual expense ratio, at least on their 2030, of 0.72%. 0.72%. Then just under 3 places underneath Vanguard, down the list, still with a bronze rating, are the J.P. Morgan Smart Retirement Funds with a 4.5% commission. Okay, a little lower commission, but annual fees of almost 0.8% of 1%. And what I find fascinating is that Schwab funds, which are very inexpensive, dimensional funds, which have I think they have an investing process far superior to any of these active products like T. Rowe Price or American funds, they end up with a neutral rating and are below many of these more expensive front-end loaded products. And there are a ton, by the way, of front-loaded products on this list. Funds from Voya, funds from John Hancock, funds from Nuveen, funds from Principal, the insurance company. They're certainly fair, at least in their ignorance of fees. They're just saying these are the better funds despite what they charge. But you can't pick investments in that kind of a vacuum. As a matter of fact, we believe that fees are one of the top indicators of potential returns, one of the best indicators of potential returns. If you have a fund that is identical to another fund, to exactly the same investment vehicles, and one charges 0.1% of 1% and the other charges 1%, the 0.1% of 1% fund is going to make you almost 1% per year more money. Absolutely no doubt about it. If their portfolios are the same, you're going to make more money when you pay less. Now, are there reasons to pay more? Sure. you might want to pay more if somebody's providing you with personal advice like an advisor. There are actual studies that show, as a matter of fact, we're going to talk with Vanguard about this in the not too distant future. There are studies that show having a personal manager can help you make more money because it forces you to do things you're supposed to do rather than things you are emotionally driven doing. But active management, there's no basis in saying they're better. None whatsoever. 855-935-TALK. Give me a call.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hey there, Don McDonald here. Tom on vacation. Give me a call. Don't give us a call because it's only one of us. 855-935-TALK. 855-935-8255. Looking at a recent piece from Morningstar about their favorite target date funds, and many of which are high fee, many of which have front-end loads, many of which are actively managed. And you know the arguments about active management. We've talked about them before. There is no evidence that in aggregate, actively managed funds outperform index or rules-based funds. As a matter of fact, there is evidence to the contrary. The longer the comparison period, the less likely it is that an actively managed fund will outperform the indexes or their benchmarks. And the numbers are pretty pathetic. The numbers that outperform, as a matter of fact, they're so pathetic as to be worthless. As a matter of fact, they're so bad that the performance of active managers is worse than you would expect if it was just a series of lucky decisions, because active management costs more. So that was the point I was making before the break. The higher costs of active management or the higher costs of expensive funds detract from returns. They have to. But the other thing that is absolutely stupid about many of these funds is the fact that you're paying a commission to get in. Never does a commission provide any investor value. All the commission is there to do is to pay the person who suggested the fund to you, who sold you the product. It does not help make it better. It does not give you a better advisor. As a matter of fact, I would hold that it gives you a worse advisor because their incentive is to move on and make the next sale. Their incentive is not to service you because they don't get paid for taking care of you. They get paid for selling you something, and then it's on to the next client, the next sale. However, the industry, the financial industry, the loaded fund industry, companies like J.P. Morgan, Chase, LPL, Voya, Ameriprise, the list goes on. Companies like that will argue that paying a load is preferable to paying a high fee. Well, okay. But which high fee funds are we talking about? Generally, what they and almost every single comparison I've ever seen is when they compare themselves to themselves. And this is an important fact for you to understand. They have competing products. Most mutual fund companies and brokerage firms have different classes of shares. And we've talked about this a lot, but I still think people don't get it. You have A shares, which have that 5.5%, 5.75% even percent upfront commission. That comes right out of your dollars. So you put $10,000 in, they are going to take $575 away. Bye-bye. It's gone. You don't get your entire $10,000 invested. Now, they'll argue, well, but that 5.75% up front is better than paying 1.5% per year. Well, which funds charge 1.5% per year? It's their own funds, their B shares, and particularly their C shares, where they charge the commission on an annual basis. They just raise the fee by about 1% per year over what the fund itself charges, and then that 1% per year goes into a pool to pay the broker's commissions at 5%. So they're comparing their performance with a load against their performance with a hidden load. Well, that's disingenuous, at the very least, if not outright fraudulent, but of course, the SEC allows them to say this stuff. Because they're powerful. They're these loaded fund groups and these major brokerage firms have huge, huge power. And so the only way you're going to compete with them is for you to know what's going on, you to pay attention. 855-935-TALK. Call me.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
There's nothing that has a bigger impact on the way you live than money, and that's why we're here. On Saturdays, Tom and I get together to talk with you on the radio in Seattle at 855-935-TALK, 855-935-8255, and then we turn this show into a podcast later. So give me a call, 855-935-8255, and let's go down the Puget Sound area to Tacoma. Tom, welcome to the program. Oh, finally, I got a Tom joining me.
Yes, just before I make my comment, Tom was supposed to call you this week. That's what he said last week. Have he called you yet?
No, he hasn't. He's having too much fun.
Oh, okay, good enough.
He's having too. He may be on a train. I think he may be taking a train. I don't know what he's doing. I can't keep up. He's having too much fun.
Okay. 50-50, trying to get to a 50-50 mix on VT and BND and other types of conservative things in the BND and some certificates. My question is, I have AVUV. What percentage should I use of the 50 that goes into the stock market between VT and AVUV? I'm not going to need this. I don't believe I will. Hopefully never need this money. You'll probably be left behind.
With a 50-50 allocation, I would have 40% in VT, 10% of the total in AVUV, and then 50% in your fixed income and BND and whatever else you happen to have in that fixed income portion of the portfolio. So about 20% of the equities I would have in small cap and value, which is what AVUV gets you, the Advantis Small Cap Value Fund.
Excellent. Okay. That's what I wanted to know, because I have about 4.5%, so I said I wanted to find out.
Yeah,
so
I think you need
I'll move that up to 10%.
I would have it at about 20%. If that's the only other addition the only other asset class change you're making, which is, by the way, the one I would recommend first anyway, is to go small in value. And as you said, you're not going to be using this, so it's money that can fluctuate more. Plus, you got 50% of this portfolio that's not going to do much of anything in terms of volatility. So you're in good shape.
Okay.
All right.
Excellent. So you would go with 20% in AVUV.
20% of the 100%, yes.
Right.
I mean, not of the 100, I'm sorry, 10% of the 100, 20% of the 50. So it would be 50% bonds, 40% VT, 10% AVUV.
Okay. Excellent.
All right, sir.
Thanks a lot.
You're welcome. Thanks for calling. And by the way, I know what the weather is in the Seattle area, guys. I know it's not good, so you don't have that fair weather excuse for not calling. Oh, it's a lovely day. I'm not going to call a radio show. I know it's – we were at lunch, Debbie and I, and she goes, what kind of weather is it going to be? Because she knows there's the weather effect on callers. The worse the weather is, generally, the more calls we get. She said, what's the weather going to be like? And I said, I have no idea. Let me look. And I looked and I went, whoa, a high of 60 degrees? Really? There are places in the lower 48 United States that go down to, they only get up to 60 for the high? I mean, even on a cloudy day, we get up to 90 down here. And my poor child in New York, they're just getting slammed. It's going to feel like 107. Anyway, if you've got a question or a comment or an opinion about something financial, or you just want to talk about your life and how you spend money, call me because I'm free and I'm easy. And that number is 855-935-TALK. That's 855-935-8255. And we will try to cover some of the most important parts of particularly of the investing world. And when we come back from this next break, which is approaching very quickly, I want to talk a little bit about, and this came up from an article I read about safe investments, where they mentioned annuities. And I want to talk, one, about the safety of annuities, because that's all relative. But I also, this article mentioned surrender charges. And I don't know that a lot of these financial writers and pundits are aware of the real scope of surrender charges. And you need to know this. 855-935-TALK is the phone number, 855-935-8255. I'm Don. Tom's on vacation. We'll be right back.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Hello again. Welcome back. I'm Don. This is Talking Real Money. Tom's on vacation. You can call me at 855-935-TALK, 855-935-8255. Before the break, I was talking about an article I read about safe investments. And, of course, the article included annuities. It says, yeah, annuities, they're pretty safe if you have a safe insurance company. But the ended the section saying the biggest risk to annuities is the fact that your money is tied up. If you want to withdraw funds early, you'll have to pay a surrender charge, which can be as high as 7% of the amount you withdraw. Wow. Apparently, 7% sounds horrible, right? But that's low. That's really low. If you want to use as high as, the highest surrender charge I have ever found is on an annuity from a company in Iowa called American Equity, and they have an annuity with a first-year surrender charge. If you want to take your money out more than 10%, you can take 10% out without a surrender. If you want to take your whole, like you want to get it all, you don't like the annuity, you want it all out, they're going to charge you 12.5% of the amount in the annuity to take it out year one. Well, it must get better year two, right? Sure it does. Goes down to 12%. How about year three? Must go down from there. Nope, still 12%. Year four? Come on. Yes, 11. Only 11. Year 5, 10. Year 6, 9. Year 7, 8. And here's that 7 she mentioned in that article. After 8 years in this annuity, you would still have to pay them 7% to get out. Do you see why we just really, really don't like annuities? 855-935-TALK is the phone number. Please call. I'd love to talk with you. It's just me, so it's easier. There won't be two people talking to you, just one at a time. And Beth in Lakewood, welcome to the program. Beth?
Hey, how are you?
I'm good. How are you?
I'm doing great. So basically, I don't know a lot about financial stuff, and I have a Roth IRA that I have set up through my work, and they deduct an amount and they stick it in. And I currently have a little over $17,000, and obviously there's like compound interest magic that's happening. But I'm 43, and I'm feeling like I don't even know how much I'm supposed to have for retirement, but it feels really low at $17,000, and I'm thinking maybe I should bring it up, or maybe I should diversify something, but I don't know what else to put anything in.
Well, if you can afford to save more for retirement, you absolutely should. However, having, compared to most of the country, having anything at 43 is pretty good, because a lot of people in their 40s basically have nothing, and they really are behind the eight ball when it comes to, in your 50s and 60s, and you're starting to sweat it. But you could certainly put more away, and if you can afford to do it, please do it. How is this Roth invested? What's it in?
Honestly, I don't really. It's like some sort of combination thing. They sat down with me when I first set it up, and they said, this is where you want to go, and this is moderate risk thing. And they did a much better job of explaining it than I am.
No, and that's because it's their job. It's not your job to explain it. But when it comes to getting the most out of this, it would really help if you could find one of your statements and let us know what's in there so we can see if it's a good portfolio just there. But over and above that, how much are you putting into it every year?
So every year it's $2,400 that I put in overall, because it's $200 a month times 12.
Okay.
And I can definitely afford to put in more. They just said put in.
Yeah, I mean, you're doing something, and that's awesome. That's awesome. But I tell you, you can put up to $7,000 a year in a Roth IRA. No, I take that back. Yeah, it's still $7,000. Yes, it's $7,000 in 2025. You can put $7,000 into a Roth. So what I would suggest you do is go to Vanguard or to Schwab or Fidelity or whomever and open your own Roth IRA.
Okay.
That's outside of your company. And at 43 years old, it should probably be primarily invested in really broadly diversified equities.
Okay.
Although I really would suggest you go to talkingrealmoney.com and take the risk quiz just to make sure, which is free and easy, and it's so simple. But if you had something somewhere else, I would know that you're going to have better investments. I mean, for example, if you went to Vanguard, I would probably, if your risk quiz says you can take a lot of risk, and you certainly have the time to do that, then you should probably have all of it in something like VT right off the bat, the Vanguard Total Stock Index Fund, just because it's broad, it's diversified, it's cheap.
All right.
And then when you get a chance, find your statement and call us back on what's in the Roth.
Sounds like a good plan.
And are they giving you anything to do it through your company? Are they just helping you out? Or what's the deal? It's not a 401k, right? You said it was an IRA.
It's a Roth IRA. I have a pension through my work, and it's Class B. I want to say something about a B pension.
Okay.
And it doesn't pay very much. Everybody who's ever retired through the company says it's very, very little amount of money, and you need to have something else.
Yeah, well, the fact that you have any kind of a pension at all is kind of cool in this environment because most people don't. So that's a bonus. That's a bonus. But the more you can save, if you can afford to save more, please start saving more. Just set up your own Roth and do that. But when you get a minute, just give us some more information on the one you have. It may be that you're just better off getting out of that Roth at work and doing everything on your own.
All right.
Okay.
That's good advice. Thank you so much.
Thank you, Beth. Thanks for the call. I really appreciate it. 855-935-TALK is our phone number. And Denny, you're up. Welcome to the program.
Hey, Don. Good to talk to you.
Glad you called. What can I do for you today, sir?
Great. My wife received an inherited IRA in 2020 from her folks, and I've been under the understanding, trying to manage that, the taxes and so on, that we had a 10-year window to sort of do what made sense to us. As I revisited that this last filing year, I noticed a provision, what I understand to be that if it was being drawn on already, that we actually did have to adhere to a schedule.
Yep, you
her
do.
Folks were, I think her dad was 81 when he passed. And now I'm in a tricky situation where I might have to pay some back. We had to have been drawing that down then at the same rate they did or something to that effect. Can you give me any more insight on that?
And this is, by the way, this is where I mentioned earlier in the show that I had a correction. This was where the correction came in. I forgot that if someone was already taking distributions, that you can't wait till the end of the 10 years and just take it all out then. You have to continue those distributions, but it all still has to be drawn down by the end of 10 years. So if you haven't done it, technically, and you probably should, go back and amend those returns so that but it still has to be taken out in this case over that 10-year period.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And this RMD stuff, the inherited IRAs are such a mess now. They are incredibly confusing. I've been doing a lot of reading on this lately because it's coming up a lot. And if you are not a spouse, basically, then you're required to liquidate the account by the end of the 10th year. However, if the person who died, the decedent, had already started taking RMDs, then those RMDs are required in years 1, 2, 3, 4, 5, 6, 7, 8, 9. So it is a very confusing situation. And I have to say, to make sure you get it right, I've even played with some of the calculators. It's really confusing. I would absolutely, in at least the first year I had an inherited IRA, I would meet with a CPA. I would meet with an accountant to make sure you don't mess this up, because it is very confusing. There are all kinds of beneficiaries to which certain rules apply and others to which other rules don't apply. And then there's a 5-year rule. And why Congress does this to us, I will truly never understand. So anyway, consult with an expert. We're coming up on the end of an hour, and I appreciate you guys being there. Those of you who are on the line, I don't want to cut you short. So I'm going to ask, please, Joel and Randy, hang in there until the next hour. I know it's going to be a bit of a wait. You can just set your phone down or whatever, or just listen on your phone. And the rest of you, please give me a call, 855-935-TALK, 855-935-8255. If you don't get a chance to call during our Saturday show, this is our only window for taking live questions, for actually having this give and take conversation. This is the only time. We're trying to come up with another way to do this during the week too, during another hour. But right now, Saturdays starting at noon Pacific time, when we do our show in Seattle on Northwest News Radio, is the time to call. Noon to 2, 3 to 5 Eastern at 855-935-TALK. But if you can't get your question in, easy for me to say, if you can't get your question in during that window, well, go to talkingrealmoney.com. That's our website, all kinds of good stuff there. And just click on the contact form. There are a couple of ways to send in your questions. 1, you can type it in. 2, if you have you're using a phone with a good mic, and they almost all have good mics now, or you have a mic on your computer, you can record your question. Those I answer on the Friday show. The ones that are typed get answered on this show, on the other podcasts we do, or when Tom and Roxy do one. So there's all kinds of ways to get help, and that's the whole point behind this show. That's why we do it. Yeah, we do it to make a living, but really, I do it more to do what's right for you, to try to help you do this better so you don't get ripped off. And by the way, if you'd like to meet with one of Appella's advisors, you can do that for free. We don't charge anything. We don't pressure you to do anything. Just go to talkingrealmoney.com and click the button that says Meet an Advisor.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's AVUV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.